Hello, welcome back to Chapter 13, final installment video where we're going to talk about stock market ratios. There's 4 different ratios that we're going to be talking about today. Stock market ratios analyze the earnings and dividends of a company. Earnings per share is one of the most common ratios that investors look at. It's computed as the net earnings available for common stock divided by the average number of outstanding common shares. The average number of outstanding common shares is computed by adding the shares outstanding at the beginning of the year to the shares outstanding at the end of the year and dividing by 2. The measure indicates how much income was earned for each share of common stock outstanding. So this confuses a lot of people, this preferred dividends. Most companies do not have preferred dividends, so unless you are told or you see preferred dividends on the balance sheet, then this is typically 0 and you're just looking at the net income. So for the company that we've been analyzing in this chapter, they have an earnings per share of $1.60. So that means that for every share of common stock, they earn $1.60 for investors. Book value per share looks at stockholders' equity, again minus preferred dividends, which is typically 0, divided by outstanding common shares. It measures the amount that would be distributed to holders of each share of common stock if all the assets were sold at their balance sheet carrying amounts and if all creditors were paid off. It's based entirely on historical cost. So if the company were to close today, each shareholder would get $20.80 in assets. Price earnings ratio is looking at comparing the earnings of a company to the market price for a share of the company's stock. In general, a higher price to earnings ratio indicates the market is more optimistic about a company's growth potential than it is about a company with a lower price to earnings ratio. And again, you can't look at this in a vacuum. You need to understand what the average or typical PE ratio is for companies in the industry that you're analyzing. Dividend yield is looked at as the dividends per share divided by the market price per share. There are 2 ways to profit from a stock investment. 1, investors can sell the stock for more than they paid to purchase it, hopefully if the stock price rises. And 2, the company that issued the stock can pay cash dividends to the shareholders. Most investors view rising stock prices as the primary reward for investing in stock. The importance of receiving dividends, however, should not be overlooked. So this ratio measures the rate of return in the form of cash dividends only that would be earned by an investor who buys common stock at the current market price. Again, higher is typically better, but you need to understand the industry that you're in and the trends of that company. And then finally, there's different limitations of financial statement analysis. Users can rely on financial statement analysis only as a general guide to the potential of a business. Many factors must be considered before making any judgments. For example, different industries may be affected by unique social policies, special accounting procedures, or other individual industry attributes, which is really why it's difficult to compare companies within different industries. When comparing firms, analysts must be alert to changes in general economic trends from year to year. And finally, financial statement analysis is only as reliable as the data on which it is based. Although many firms follow GAAP, a wide variety of acceptable accounting methods is available from which to choose from, including different inventory and depreciation methods, different schedules for recognizing revenue, and different ways to account for oil and gas exploration costs. So you need to keep these differences in mind when comparing companies. Please let me know if you have any questions on Chapter 13. Thank you.